Welcome to a new IFRS Share series. It's an initiative of OJ Samuels Accounting and Reporting. In this session, we shall be considering cumulative set 310 questions to which the answers are provided on IAS 8. This is standard on accounting policies, changes in accounting estimates, and errors. Viewers or subscribers have 15 seconds to select or choose the answer to each question. The answer to each question is reviewed after each question. Please enjoy it. Question number 21. With respect to accounting policies, estimates, and errors, the meaning of material is found in A. IAS 1, B. IAS 2, C. IAS 8, D. IAS 10, E. IAS 36. Some counts. 5 seconds gone. 10 seconds gone. Time up. The answer to question number 21 is A. IAS 1. A. IAS 1. The meaning of materiality for use or consideration under any of the standards is found in IAS 1, titled Presentation of Financial Statements, which will later be replaced by IFRS 18, titled Presentation and Disclosure in Financial Statements. While the meaning of materiality was contained formally in IAS 8, titled Accounting Policies, Changes in Accounting Estimates and Errors, it was located to IAS 1. IAS 8 refers to IAS 1 for the meaning of materiality. A is the answer to question number 21. Question number 22. Restatement of correction of prior period error not affecting retained earnings implies that A. No asset is affected only. B. No liability is affected only. C. No component of equity is affected only. D. None of assets, liabilities, and components of equity is affected. E. Asset or liability is affected. Some counts. 5 seconds gone. 10 seconds gone. Time up. The answer to question number 22 is E. Asset or liability is affected. E. Asset or liability is affected. When the statement of correction of prior period error does not affect retained earnings, it implies that no income or expense item is involved. Therefore, the correction will be between those elements of financial statements that are assets and or liabilities and are components of equity other than retained earnings. E is the answer to question number 22. Question number 23. Restatement of correction of prior period error affecting retained earnings implies that A. Income cannot be involved. B. Expense cannot be involved. C. Asset or liability cannot be involved. D. Other components of equity cannot be involved. E. None of the above applies. Some counts. 5 seconds gone. 10 seconds gone. Time up. The answer to question number 23 is E. None of the above applies. E. None of the above applies. Restatement of correction of prior period error affecting retained earnings involves items of income or expenses, or both income and expenses. Income and expenses arise or flow from assets or liability or certain transactions relating to components of equity. Therefore, income, expense, asset, liability, and other components of equity may be involved. E is the answer to question number 23. Question number 24. Correction of error of a current period can A. Not affect the profit and loss for the reporting period. B. Affect other comprehensive income for a reporting period. C. Not affect comprehensive income for a reporting period. D. Affect the opening balance of retained earnings. E. Affect the opening balance of retained earnings restated. Some counts. 5 seconds gone. 10 seconds gone. Time up. The answer to question number 24 is B. Affect other comprehensive income for a reporting period. B. Affect other comprehensive income for a reporting period. Current period errors discovered in a period are corrected before the financial statements are authorized for issue. This correction has no linkage in any form with adjustments that are done on any date of balances of retained earnings. Of course, correction of current period error affects the profit and loss and other comprehensive income for reporting period. B is the answer to question number 24. Question number 25. After reflecting the correction of prior period error in the relevant opening balance in the statement of changes in equity, the resultant figure is called A. Opening balance, B. Opening balance restated, C. Opening balance adjusted, D. Opening balance revised, E. Opening balance recalculated. Some counts. 5 seconds gone. 10 seconds gone. Time up. The answer to question number 25 is B. Opening balance restated. B. Opening balance restated. The resultant figure or balance arrived at after reflecting the correction of prior period error in the relevant opening balance in the statement of changes in equity is called opening balance restated. B is the answer to question number 25. Question number 26. Reclassification as a correction of error does not affect the balance in an or in A. Asset, B. Liability, C. Issued share capital, D. Retained earnings, E. All of the above. Some counts. 5 seconds gone. 10 seconds gone. Time up. The answer to question number 26 is E. All of the above. E. All of the above. Correction of error done through or as a reclassification does not affect the balance of assets, liability, and equity elements of financial statements. Balances of assets, liabilities, and components of equity remains what they are. The items affected are the subtotals, totals, or line item summation or netting amounts arrived at through reclassification. E is the answer to question number 26. Question number 27. The income tax expense effect of prior period error correction in a comparative year is presented in A. Statement of changes in equity in the comparative year. B. Statement of changes in equity in the reporting year. C. Income tax expense line item in the comparative year in statement of comprehensive income. D. Income tax expense line item in the reporting year in the statement of comprehensive income. E. Statement of profit and loss in the comparative year as part of other expenses. Some counts. 5 seconds gone. 10 seconds gone. Time up. The answer to question number 27 is C. Income tax expense line item in the comparative year in statement of comprehensive income. C. Income tax expense line item in the comparative year in statement of comprehensive income. The income tax expense effect of prior period error correction in the comparative year is presented in the income tax expense line item in the comparative year in statement of comprehensive income. C is the answer to question number 27. Question number 28. The income tax expense effect of correction for prior period error before the comparative year or years presented is reflected in A. Closing balance of retained earnings of the latest comparative year. B. Opening balance of retained earnings of the latest comparative year. C. Opening balance of retained earnings of the earliest comparative year. D. Closing balance of retained earnings of the earliest comparative year. E. Income tax expense line item of statement of comprehensive income of the earliest comparative year. Some counts. 5 seconds gone. 10 seconds gone. Time up. The answer to question number 28 is C, opening balance of retained earnings of the earliest comparative year. C, opening balance of retained earnings of the earliest comparative year. The income tax expense effect of correction for prior period error that occurred before the comparative year or years presented is reflected in the opening balance of retained earnings of the earliest comparative year presented. Where a one-year comparative year is presented, the income tax expense effect is reflected in the opening balance of retained earnings of that comparative year. Where two or more comparative years are presented, the income tax expense effect is reflected in the opening balance of retained earnings of the earlier or earliest comparative year presented as applicable. The balance arrived at after reflecting this prior year error correction is called opening balance restated. C is the answer to question number 28. Question number 29. The authority's fair assessment leading to increase in income tax liability for a comparative year is reflected as A, part of income tax expense for the reporting period. B, part of income tax expense for the comparative period. C, adjustment to retained earnings for the reporting period. D, adjustment to retained earnings for the comparative period. E, adjustment to current tax payable for the comparative period. Some counts. 5 seconds gone. 10 seconds gone. Time up. The answer to question number 29 is A, part of income tax expense for reporting period. A, part of income tax expense for the reporting period. Tax authorities' reassessment leading to increase in income tax liability for a comparative year is a change in accounting estimate. Change in accounting estimates is prospectively applied. The effect of prospective application is the recognition of the increased income tax liability of a comparative year as part of income tax expense for reporting period. It is reflected in a current year, not the comparative year, as it is not a correction of error, but revision of accounting estimate. A is the answer to question number 29. Question number 30. The correction of collected sales tax omitted in the books in a comparative year, where the appropriate sales are reported, has the effect of A, reducing the profit for the comparative year. B, increasing the profit for the comparative year. C, reducing the profit for the reporting year. D, increasing the profit for the reporting year. E, none of the above. Some counts. 5 seconds gone. 10 seconds gone. Time up. The answer to question number 30 is E, none of the above. E, none of the above. Correction of collected sales tax omitted in a comparative year has no effect on the profit or loss of an entity where the appropriate sales are reported. Sales tax is neither an income nor an expense to an entity because it is a tax charge on sales and collected from buyers, clients, or customers on behalf of the tax authority. The correction of the collected sales tax omitted in this case increases the cash and cash equivalents and other payables proportionately. Statement of profit or loss for none of the years is affected. E is the answer to question number 30. That is all for this set, and we hope you had fun. We invite you to subscribe to our channel, share our links, and kindly invite those in your network to do the same. This will enable you and all of those subscribers get direct notifications on future video uploads. Thank you, and bye for now.